King of Podcasts Radio Network proudly presents the Broadcasters Podcast. Here is the King of Podcasts.
We're going to follow up on a subject I only touched upon last week on the program, and that was Audacy. Now that the fact that Soros Management Group is now helping to buy 40% of the company in the realm of having to go ahead and help the company out with their bankruptcy bailout. So because of the fact that the company was able to go ahead and get their debt down to $300 million, from $1.9 billion. Now, of course, the company is very much enticing to a private entity, private equity vulture like Soros Management Group. Now, remember, I don't want to talk about anything when it comes to the politicization of what this move can do. As we talked about last week, we know that there were a various number 18 radio stations in Spanish that were bought out by the Soros Management Group previously. Remember, we talked about that. And what happens now is the same thing goes, right? It's another point of where another company comes in and hey, if they can go ahead and buy it, they will. And why shouldn't they? Right? That's what they did. So as we talked about it last week, Soros Fund Management. There we go. Soros Fund Management is now the biggest shareholder of Audacy. 40% of the company is now in their favor. And Audacy is now closing out its Chapter 11 bankruptcy. Court hearing was already scheduled, and we're going to talk about the whole story about the bankruptcy filing and how it's been completed. So Audacy's been bailed out. They've been given the chance to go and have new life. These shareholders that were all part of this public offering that was offered a while back, they all get screwed. Remember, Soros Fund Management comes in on the back end and say, okay, well, we're going to take over the debt. $415 million of Audacy's first lien debt. And once they come out of bankruptcy, Soros Fund Management now becomes the largest shareholder of Audacy. Again, it's not because of the fact that, listen, and everybody wants to go now and talk about the fact that, okay, the vice president of news at Audacy has dropped. He has stepped down. We'll talk about that. Again, there's all these pieces that are coming together, and we're going to bring it up. But it still comes down to the fact of the aspect of when a corporation decides to go ahead and acquire a media company. This has been going on since this deregulation in 1996. It all goes back to that. Okay, so newspapers, media publications, television networks, they've all been suspect to this. Okay, but my focus is on radio because when I first got into being in this business, when I grew up being interested in being in the radio business, I grew up on it and loving it and saying, look at the fun everybody's having. Look at what we get to do. We get to play all this great new music or all this great music in general. The entertainment side of it, the theater of the mind, talk radio, music radio, classical music, if you wanted to have it on there, jazz, like all the various genres that can be played. And so many others that can be brought up to us. The cultural music, the diversity, all of this going on, the programming, the fun, off the cuff, live, local. It was so fascinating to me. And because of the time frame of me not being able to be in this business until I graduated college, and I couldn't really get into the business I love until I was able to get myself through a long, rigorous system. Because remember, from 1984 up until 2002, I kept trying my hardest to get into radio. I took meetings. I took some ideas from others about, well, send your resume with a pair of shoes, in a shoebox, or just the way you present it, or, go to the station and just go ask them, go talk to the program director. And I did all that regularly. Air checks I sent out all over the place around West Palm because I wanted to go ahead and work here. And, I didn't have the experience. Well, when I did start getting experience, it was at the college radio station I worked at, WOWL, right? And so we did that, and I'll tell you, it was fun. Like I said, 30 years ago, on January 30th was the first chance I got in front of a microphone. January 30th, 1994. And solidifying the dream that I had to be in radio and to do broadcasting was going to happen. And it did. And it was fascinating. And I loved it. But man, it's like, what can I do now? Like I really wanted to go and hold on to it and do something more, but it never got to be that way. And that's what's unfortunate, because like I really wanted to enjoy more and more of everything and anything when it came to this business. And we didn't get a chance to do that. I mean, I heard all the fun there was, but by the time I got here and finally got myself solidified into the business, well, too late. Because by the time I got in, deregulation came into play. It happened while I was in college. I didn't really understand what it all meant, but I saw radio wasn't going to be the same anymore. But I really didn't know what it was going to do. And some almost 30 years later, I never realized how much damage this could do. And who were the people responsible for doing this real damage? First of all, it's the corporations. The ones that said, we're just going to go and come in here without knowing an idea, an inkling of what this business is all about. We're just going to come in here, buy it up. It's already making money. We could just, take a couple things out, streamline it, and it'll still make money. It's just a cash machine. Yeah. And then they weren't ready in 1994 we're talking 1996 into the 2000s because internet. No one gave anyone a thought that the internet was going to come around and do something big, but it did. And the media companies that decided after deregulation happened, they thought, well, this wasn't going to hurt anybody. Well, sure did. It sure did. And all we've been doing right now is the continuous decline, the slow decline of media across the board. And the only saving grace is the fact that the internet's still out there. Okay. For radio companies, for people that were in radio broadcasting in the first place, the only bastion you have is the internet through streaming, which people really don't live stream, a lot of music or talk content. You can, of course, but it's not the major way that people listen. Of course, streaming, we don't listen to people introducing the records much anymore. That's very passé. I get it. Because if you have Spotify or Apple Podcasts, and hey, Spotify, thanks for trying with the DJ format. It never really caught my attention. I really never enjoyed it. I really wish I still had real people that knew how to do radio still do it, but it's not that way. So all I have are the air checks of those of old, 50s, 60s, 70s, 80s, that knew how to do it, knew how to present new music, knew how to present records, knew how to open our ears to new music, because they did. All of it. And then when corporate radio came in, corporate companies decided to come in. No one that was in the radio business decided they wanted to keep it, but this is corporate anyway. And let's make it public. Let's publicly trade this company and see if we can make money off of that. So again, a couple of different revenue streams. Failing. They raise the rates. They increase the ad space. They try to revenue every different stream possible. They don't care. They just want to make as much money as they can possible. And they can continue to go ahead and, micromanage and dwindle down the staffing to nothing. That's what they're going to do. This is how newspapers gone down. In some ways, you wonder where the music industry's gone, where it's been. Well, a little bit of this has gone on as well. But private equity. Soros Fund Management is not the only player in this. There's plenty of them. They're just one in a cog of other companies that, hey, they got the money to play with. But they don't want to go ahead and take the company and do an honest way of using resources and putting money into the business to build it better. They're not in the business of that. Private equity, they take these stations off the market. They take these stations and make them private. So their operations, their revenue, whatever they're doing right now, doesn't get put in the books. And then what happens? Well, then there are assets that all these companies have. And like vultures, they're just bones to pick off. And so these radio companies, sure, there might be other avenues they might try to go ahead and, create revenue. Let's try to do something else they can work with. Let's buy other companies that we can use as technology to work with these companies. Or let's go into podcasting, and we're going to try to take it over. We're going to take our own resources and go into that avenue, right? They tried digital streaming. They tried podcasting. They're not the leaders in this. Now, do you wonder why National Public Radio is able to do so well? It's because they realized early on they need to do this because you know what? At one point, public support is not going to be enough for this. And the government money that's being put to go ahead and prop those companies up is going to run dry. Okay. They're going to realize, just like these other media companies that are failing, all right? The NPR model, yeah, listener supported. So you have people that are definitely vested interest in it, but the investors are the public. The investors in these private companies, made private, formerly public, are private equity firms. And when they do that, no one else's money gets involved. They'll do what they want with these stations. And no matter how much we might have enjoyed them, or who they were, and what legacy they might have had, they don't care. They're going to pick apart the bones. Okay? Once they get the company that was, could have made some money, could have done some things with, when they decide to take away the opportunities, drop the morale, create this dystopian society of, well, we don't need people in these radio stations. We don't need people live reading liners, and we don't need them doing the commercials. We could use AI for that now. Remember we talked about that a couple of years ago, right after COVID? So we can get AI people to do that now, right? Oh, the broadcasters, they don't need to be in studio. We can just get them in from anywhere. They can just voice track, right? Oh, no. Oh, automation? Oh, we don't need anybody in there. Oh, we just got these machines that can play the music. They could just be jukeboxes. They don't need to be anything else. That's all they got to be. Oh, we have all these HD channels. We can just put some other stuff on there. We don't really care what goes on there. No, of course not. But this is no surprise to me. And of course, I think other people really don't care about this at all. It's like, oh, it is what it is. Well, I'm sorry. I don't want it to be that way. If I'm going to be the only voice speaking up vocally of anybody else that I know, okay, no one else in this industry wants to talk up. All right. Let me just say it like this. There are enough people out there in the radio industry that they can't talk like this. Fred Jacobs, all these industry types, they can't, they can't talk like this, right? They're not allowed to talk like this. The folks at like All Access, Joel Denver, he would never be able to talk like this. The guy Ross on radio that I talk about, that I regularly mention, Fred Jacobs, he can't do it. He kind of sort of does it, but he really can't. But think about that. There's a lot of these things that go on where people can't say anything about it. No one can say a word. All these radio companies, Talkers Magazine, right? They can't say anything. They're not allowed to. I mean, even if they do, they can't afford to go ahead and just drop off. Just can't do it. And that's the problem we have right now. So what do you do next? What else is there about where things go? I mean, like, that's the problem. We are at a point in radio where, there's no options here. I'm waiting for all these stations to implode. The corporate companies, that they don't get the breaks that the FCC gives them. They don't get the breaks of bankruptcy in Chapter 11 to allow them to continue to fail, the continued decline of all these radio stations. I'm going to fight for these stations because these outlets, okay, they answer a lot of opportunities. Okay, when everybody talks about, the lack of free speech or the lack of, content or programming that's out there, diversity, equity, and inclusion, that real thing, not this performative kind of stuff that we all talk about, the real diversity, equity, inclusion, that was in radio. It was always in radio. The staffing, the formats, the music, ethnic, cultural, whatever it is. I mean, there are still stations around the country. If you want to hear a particular format, you want to hear Bollywood music, you have stations in America that do that. You want to hear, Asian talk, you have them all over California. You want to hear Spanish, there's a load of it. You want to hear urban stations, or what might have been called black stations or soul stations back in the day, you got all those, and a plenty. And by the way, their signals and their broadcasting can be just as potent and powerful. Let me tell you something. The reason why rock and roll ever got to be what it was is because you had radio stations around the country that played what was called race records. Okay. How else did the other communities hear the music? It's because they heard the other radio stations. They were not censored. They were not blocked off. They were on the free airways that the people own, and people were able to go and hear them. Okay. If you wanted to have a political stand, you want to have other opinions or things being put out, listen to religion. Religious stations are all over the place, and you can hear the word of God in various, denominations and formats and whatever. So freedom of speech, freedom of thought, all over radio. But these companies, they don't care about that. They just prefer to go ahead and just move off to something else. That's what they wanted to do. It's just for money. And part of it might be that there's a control factor of like, well, if they can do this and they're allowed to hold on to these stations and they don't get penalized for failing constantly, then they get to do that. Okay, iHeartMedia is the worst culprit. We talked about them, right? We talking about, their latest, the debt decrease they're getting, trying to be able to pay their interest payments on their debt in 2018, going from $20 billion down to $5.75 billion, whatever. Right? And now the latest culprit is Audacy. Again, $1.9 billion. Maybe not so much. They're not the big hefty price tag that iHeartMedia did. But again, Audacy is a conglomeration of other things. Entercom, CBS Radio, Infinity Broadcasting, all of that. And the fact that David Field was able to go and do that, it says everything. Allowed to fail. The Dickey brothers allowing Cumulus to go on, take ABC, take Citadel, and combine it all together, and also fail at the same time. I detest all these companies for what they're doing. I love radio, and I will still continue to defend it. It's not a dying medium that has to go away. Okay? Because one of the things you can do is you can still have digital radio. Okay, satellite radio is still around, but you know what? Even satellite radio, in its own way, is still failing because they have to continue to make cuts, and they can do what they want with their subscriptions. But again, there's private; they can do whatever they want. They got a subscription service, listener supported. But radio doesn't have to be that way. Do you think the advertisers, the music labels, have to go away? No, they're going away because the corporate suits made them. Okay. Radio stations are no longer a haven of promotion, of marketing, of branding, of, encompassing an environment that makes for good advertising. They don't do that anymore. Okay. They might be able to go and take all these they'll have their ad rep firms that'll go ahead and take all these ads from the Progressives and Geicos of the world that we've heard these commercials over and over and over because they're also in podcasting. Okay. They might be programmatic, but that's the thing is that with radio, let's just make all those ads programmatic too. We'll just automate them like everybody else. It doesn't work that way. It might work right now, but is it really being effective? No. Why do you think there are less political ads being put out there in the first place on radio? Remember, the thought process every couple of years is that these radio stations every fall, they're going to make money off the political ads. Okay. This time around, we're getting to the convention time, right? Presidential election, you only got two people. And guess what? I don't think they're necessarily going to have to put out that much money in the campaigns to put money out on radio ads. Okay. Also for the audience that they want, because the thought process is that, radio is only good for old people. Right? You abandon the younger audience. You give radio no future. You corporate suits. Okay? I mean, listen, I can't necessarily blame the private equity groups for doing what they did with radio, okay? They're just playing the game that's been played. But the SEC is complicit. The corporate radio companies that cause these companies to go ahead and put them in the controlled decline and, alienate a base of employees, thousands upon thousands of employees that have continued to be thrown out, cast aside. You let them go. And they don't get a chance to go ahead and find anywhere else they're going. So, okay, they might have to go to podcasting or somewhere else. And maybe they have to go and leave the field that they love. I've told you how many times do we have people that we know of that are very popular, okay, that came from radio experience. Listen, you can go ahead and complain all you want about Ryan Seacrest or Steve Harvey or Wendy Williams, but you know what? They all have radio experience. Expansive radio experience, okay? And what else are you going to do? There's just, radio could still have a room. Think about it like this. The way we have content creators that will go ahead and pick out new music and point out new music to us. Imagine, and by the way, this is only in America, because radio is thriving everywhere else. Everywhere else. And I can't expect NPR to do what they're doing, where they're going to go ahead and serve the music public with music stations. I can't expect that. I understand. It's not their bag. They don't have the programming for it. They don't have the wherewithal to go and do that. That's okay. Because NPR really, their bread and butter is podcasting. They're making great money on that, and good on them because they're putting out content that people are definitely following along with. That's where the real audience is. But as for the towers, the FM signals, no, I wish they could just sell them off and then reinvest that money into the podcasting, because that's where their money is. Do you need to have all these shows that they have right now run for all these hours that they do with commercials when they could just run them into podcasting format and run them on a regular basis, daily, weekly, whatever it is? They don't need radio. They don't need FM radio. I mean, radio is still podcasting. Podcasting is radio 2.0. NPR doesn't need to have the stations. They don't have to. And if you're just putting them up there in these smaller markets that really don't make much of a difference, like the bigger market stations, absolutely keep them around. WNYC, and WLRN, and all these other, major stations, right? That's okay. QED in Pittsburgh, yeah, keep them around. I understand that, but it still comes down to the fact that the corporations that created this problem, it's been allowed to continue to fester, and private equity is allowed to go and jump in. So we're going to just jump right into it. I've made my point here. Now I'm going to go ahead and lay out all the information. Here's what we got so far when it comes down to all of this. And there's been quite a bit that's been already written out about this so far. So we got to talk about it. This is, it's sad to see all this go on, but what are we going to do? It's been allowed, it's tolerated, and I hate what has been done to all this. But it's what they decided to do. And so we have quite a few stories that have already brought up about this, that have made the story about this pretty prominent. So Axios Chicago talks about, first of all, about George Soros and his company saving Chicago radio stations. Okay? Now, they're just coming into the part and talking about all the Audacy stations that are also being put in. And talking about the fact that, that the onus behind this move is supposedly that in the Chicago market, there are other stations that have conservative ties. Cumulus Media, Similar Media Group, and Nexstar Media all do. Okay? And so that's one of the parts. And here's what we got. So one of the things that has to be talked about is the fact that this was Soros Fund Management. A former Chicago Tribune columnist, John Cass, wrote a scathing piece about Soros that drew backlash from Chicago Tribune Guild union members. And they accused Cass of using anti-Semitic tropes. And then Cass left the Tribune roughly a year after the squabble. So with that, and then just all the stories that have been said about the Soros family, what they've done, I'm not here to go ahead and litigate that. Okay, this is an apolitical show. It still comes down to the fact that people are going to be feeling like this is going to be a setup because it's a political thing. You want to feel like that? Okay, got it. I get that part. But there's more to this. Really, it's just the same case as it always is when it comes down to just having another company decide, well, we're just going to head and sell, just like they always do. And it's the part that sucks more than anything. But it's allowed, it's accepted, it's what they do. And, I just wish it was like this. I really did wish it wasn't. But, what are we going to do, right? So as we know now from the bankruptcy hearing for Audacy will now equitize about $1.6 billion of funded debt, an 80% drop of their $1.9 billion of debt down to $350 million. It has been accepted. And Soros Fund Management, when you break down the $440 million in first lien debt that they own, it's $279.8 million in term loans, $135 million in revolving credit. Additional Audacy lenders named in the filing of bankruptcy court include Goldman Sachs Asset Management, PGIM, SI Capital Commercial Finance, Solus Alternative Asset Management, and Mockingbird Credit Opportunities Company. Yeah. And Audacy is allowed to go ahead and operate. They're going to continue to go do their thing without any repercussions. Slap on the wrist. Why is it they get to go and have this and continue to run? It's befuddling. It's allowed. People don't care. The bankruptcy court, this was one in the Southern District of Texas. They approved the reorganization. I don't want to talk about what David Field actually said about this, or Field, excuse me. So the new board of directors of Audacy will include Field and any successor as CEO, a chairman and two other board members from Soros Fund Management as majority shareholder, and additional members should increase their holdings to make it more than a majority of the company. Two others nominated by the first lien debt holders. The second lien debt holders will choose one member as long as they hold 80% of all the outstanding common stock. And other clauses, including Soros Fund Management is now the majority shareholder, having protective provisions preventing the board from, without its approval, including the change of the size of the board, hire or fire the CEO, enter acquisition or incurred debt above a redacted level, cause bankruptcy or insolvency, or increase any line of the annual budget by more than 5% of the prior year. They're just holding a bag. Soros Fund Management and all these other debt holders, they're just holding a bag. Because remember, they can't increase the budget. They can't do anything more to go and add to this. But they don't care. They don't really care about doing anything about that. It doesn't matter to them. They could just go along with the way it is, and they don't care any less. It's just allowed. It's acceptable. Philadelphia Inquirer also brought up the whole story, and, now they're brought into the place. So as we heard, again, conservative voices out there are nervous because now the billionaire is coming in to buy these stations or buy the majority interest in this company. So Barrett News Media wrote about this. They said, quote, "It's a long way from managing billion-dollar funds to programming local radio stations. It's hard to imagine George Soros getting involved in the day-to-day issues of radio stations. Audacy has enough problems now without trying to program its radio stations based on the political beliefs of one debt holder." So remember the story about Entercom coming in. Entercom Communications goes back to 1968. The reason that Entercom Communications got into debt is because they merged with CBS Radio in 2017. And then it was renamed Audacy. And Audacy now has 230 stations and brands, making it the second largest radio company behind iHeartMedia. Now, we already know that there were a lot of things that were going on leading up to all the changes in Philadelphia, where Audacy is housed, where their main headquarters are located. They went through layoffs in 2022, put a cost-cutting plan in place last summer, including recent cuts to their Pineapple Street podcast division, decided not to renew a broadcast deal to the Chicago Bears games, saving the company $2 to $3 million a year. And in Philadelphia, Audacy has deals to broadcast the Philadelphia Eagles and Philadelphia Philly games on WIP. Ted Gavin is the managing director of Gavin Solomonese, a bankruptcy and restructuring firm with offices in Wilmington, Delaware, says the bankruptcy restructuring would save Audacy some money that would be going to service debt payments, but it doesn't, quote, make an unprofitable business suddenly profitable, and more announcements related to cost cutting or cutting costs and raising revenue are possible. Quote, where listeners are going to see a change is as the new owners look to increase revenue and dispose of costs, you'll see probably the less popular talent go away. You'll probably also see some stations get sold, and it often means a change of format. You know, it's fine if they actually sold the stations off, but how many of them actually did they sell? And the ones that you want to see sold. That's the other problem. We don't have much that's being said about that either, and what goes on with that as a result. Nothing's really being said about that. Do you understand? It's just kind of there. And there's a lot of stories when you want to hear about the history of what goes on with all of these, we can talk about pretty extensively. One of the areas I actually looked at when it came to understanding media corporations being bought out like this. Let's just talk about this here, okay? So there was one thing I looked back, which was published in 2009 by the City University of New York, Academic Works. The Rise of Private Equity Media Ownership in the United States, a Public Interest Perspective. And succinctly, they actually really tell you the story about what goes on with radio and why it's in the situation it's in. So they talk about the implications of the influx of private equity takeovers in the United States media sector in the last decade. Again, 2009, so 1999 to now, or to this point, 10 years of that, because that was the most aggressive time of changes in media ownership, especially after 1996, because then it just started changing. Because once all these corporations started buying up all these stations and started stockpiling stations together, then we started seeing some real big changes with all these companies and all these assets being swapped around. The strategies and aims of private equity firms are explained in the context of the financial landscape that has allowed them to flourish. Their aggressive expansion of the media ownership is outlined in detail. Particular attention is paid to the public interest concerns raised by private equity media ownership relating to the frenzied nature of the buyout market, profit maximization strategies, and the heavy debt burdens imposed on acquired firms. So the structures and demands of private ownership foundationally influence the management and operations of media firms, which must necessarily serve the ultimate end of profitability within such a system. The staggering levels of concentration of corporatization and media ownership are well documented, and the resulting threats to media institutions' conventional public interest obligations have been outlined in detail. Hypercommercialism, decreasing localism, lack of diversity, and disempowered and ineffectual journalism are among the most severe social symptoms of the corporate media system. Sounds a lot like what we have today. Let me read that one more time. Hypercommercialism, decreasing localism, lack of diversity, and disempowered and ineffectual journalism are among the most severe social symptoms of the corporate media system. And existing scholarship is largely focused on the extent and ramifications of corporate media ownership. Much less is known about large-scale media ownership by institutions outside of the corporate oligopoly. Yet the last decade has been marked by an influx of investment in the U.S. media sector by non-corporate financial institutions. Specifically, private equity investment firms have ramped up acquisitions of publicly traded media companies via complex financial maneuvers such as leveraged buyouts, and then the trend of a larger rise of private equity activity in the economy as a whole since the turn of the century. Okay? And it happens to all these media companies, because there's a story I took in the same vein from The Atlantic that put out quite an interesting point in their story. This is from October 2023. This is really saddening right here, but let's make this point as well. In 2000, private equity firms managed about 4% of total U.S. corporate equity. 2021, it's now 20%. So private equity has been growing nearly 5 times faster than the U.S. economy as a whole. And then somebody writes and says, this should alarm you even if you ever bought a stock in your life. 1/5 of the market has been made effectively invisible to investors, the media, and regulators. Information is basically who owns the company, how it makes its money, or whether it's profitable, is disappearing indefinitely into private equity darkness. This is according to Harvard Law professor John Coates, writes in his book, The Problem with 12. This is not a recipe for corporate responsibility or economic stability. A private economy is one in which companies can more easily get away with wrongdoing, and an economic crisis can take everyone by surprise. And to a startling degree, a private economy is what we already have. And this is allowed. No one's saying anything about this, because you know what? When we see what happens here, the fact that companies can't just fail when they're not doing well. We have, goes back to the Great Depression, the Securities Act of 1983, the Securities Exchange Act of 1934, and what was allowed to go ahead and create points of full and fair disclosure, the SEC being brought into it. You know what? When these companies are public, at least you have somebody as a watchdog looking over this, and we can actually get information on a regular basis. But then a company can come in, no one needs to know any better about what's going on, and it's just allowed to just drop. Yeah. Neiman Reports actually put out a book about this, how hedge funds don't help destroy local news. Same thing. The ultra wealthy taking over newspapers. And the same thing goes as well. So with local news, there was a story about how the Detroit News sold in 2005 to Gannett Media, with the same people own USA Today and a bunch of other newspapers, to Media News Group. And they talk about Brian O'Connor here, who, they talk about this guy that he sat on an informal digital advisory board. In the 2000s, he proposed ideas that were included in an email newsletter. Quote, "We were told our software isn't set up. We don't have the money for that. Everything was, we can't do that. The great digital future was upon us, and we were told we can't even do a newsletter if it made money." And then the board of directors for this company talked about cost cutting and money. That's all they cared about. They were asked, what's the click rate? What's the return on investment? They took the joy out of it. And they said they could sell advertising, and then talks to engage local audiences stalled. And it was just allowed. And, Gannett was a corporate company that failed. And now they have a company called, New Times or New Media has come in. And now they have all these different newspapers, 352 markets, a new debt-free newspaper powerhouse overseeing 421 community publications, reaching more than 12 million people each week. Their stock is traded on the New York Stock Exchange, and for years between 2014 and 2019, they appeared to want to repeat the cycle all over again, buying $1 billion to acquire newspapers in Florida, Ohio, and Texas. Bad newspaper management, a predisposition to tilt decision-making consolidations and profit motivation rather than innovation and audience-centered needs. Corporate change digital strategies still floundered as news organizations indebted to private funds wrestled whether public interest reporting mattered at all. And somebody on this story, they talk about public interest reporting isn't just another tab of the homepage. It's a core value. The thing that builds trust, sets agendas, clarifies public understanding, challenges powerful institutions, and generates reform. It is, in the end, the point. But when you let private equity come in, they're just going to take and take and take. And there's nothing else left. Until there's nothing else left. They just don't care. We've talked about iHeartMedia. Go back to 2018, and when they also fell apart. Texas Monthly put a big story out about the once most powerful and feared player in radio. 2006, a pair of Boston private equity firms approached billionaire L. Lowry Mays about selling Clear Channel Communications, which owned radio stations and billboards. They were offered $26.7 billion, a number that would make the deal one of the largest buyouts in history. But for Mays, the decision to sell was a difficult one. He had spent most of his adult life building it from a single station in San Antonio to an industry behemoth. His two sons were now executives there. The price and the timing were too good to resist. Mays was getting older. Radio was facing a new wave of competition on the internet, and it seemed like the golden era of local broadcasting was over. It was a good time to get out. And they were already starting to lose money on their investment. The company lost money every year since 2007. And as we said, it got up to $20.4 billion in debt. $20.4 billion in debt from 2007 all the way up to 2018. And then he restructured and allowed to restructure. And remember the story of Larry Mays deciding to go ahead and buy all these stations, okay? When 1996, Congress removed all the limits on the number of stations one owner could have in a single market. Clear Channel decided to go ahead and buy as many as they could in every market, 1,200 nationwide at the biggest they were. And by doing that, yeah, they were making some money. Between 1995 and 2000, it was one of the best performing listings on the New York Stock Exchange. Shares generated a return of more than 1,300%. And Clear Channel branched into billboard advertising, television stations, and concert production. Investors were enamored of Clear Channel. Music aficionados bristled at its growing influence. According to the detractors, the company's centralized programming decisions aired the same DJs in multiple markets, homogenized playlists. And at one point, the company had 247 of the country's 250 biggest markets, controlled 60% of rock radio listening, and dominated top 40 formats nationwide. The Future Music Coalition in Washington, D.C. found that Clear Channel's strategy had little public benefit. Quote, when you fire so much of the local talent, replace the DJs with robots, and largely play nearly identical playlists in every market, it only makes sense that the results include fewer opportunities for musicians to get airtime. The same Future Music Coalition is trying to get the, New Music Act to try to get pushed in so that radio stations will be paying royalties to musicians. So going through this route, yes, Clear Channel did make Larry Mays a billionaire. So peaking in the 90s, the company's shares started falling by more than half. Ad markets were fragmenting. The internet enabled advertisers to target more specific audiences, so the mass marketing advertising in which Clear Channel specialized was losing its appeal. The Mays family began fielding offers for the company, and that's where they got to. Until Bain Capital and Thomas H. Lee Partners teamed up to place the highest bid, they completed the deal, took on $8 billion in debt, and then borrowed even more to finance its purchase. And that's when the company came on board and just took it. Shareholders approved the deal in 2007 of September, just a few months before the Great Recession. And then Clear Channel shares dropped. Many of the banks underwriting the deal balked as the value of the buyout fell, and the transaction ultimately went down in 2000 in July. But the suddenly adverse economic situation, the heavy debt load, and emerging competition from XM and Sirius satellite radio left the company in a hole it has never climbed out of, and it still has not. 2011, Bob Pittman brought on, former MTV co-founder, former AOL executive. He was brought in to go and make changes in 2011. He does a rebranding. Makeover doesn't improve fortunes. Local radio, outdoor advertising. Remain iHeart's main business, but steady much of the past decade, but never grown as much as they did. Then iHeart fell victim to simple mathematics. Interest payments on its debt started leveling at $1.8 billion a year. Operating cash flow was between $1.6 and $1.7 billion. Creditors tried to attempt to negotiate a prepackaged bankruptcy that could try to enable the company to restructure debt and emerge as a stronger business, but iHeart and creditors couldn't agree on terms, and letters had forced the company into bankruptcy, and iHeart was caught in a court battle. And it's all allowed and accepted. It happened in 2018. It's happened again. It keeps happening. But also talk about the fact that Audacy was getting delisted off the New York Stock Exchange, made a penny stock. So all those shareholders, just like iHeartRadio or iHeartMedia, they also got wasted. And by the way, they're still getting wasted again. The fact that the bankruptcy was so bad for iHeartMedia, they were able to go and restructure, get back out of bankruptcy. Slowly, they're whittling away at their debt, but they can't make money. And let's just put it like this too. If we look at iHeartMedia stock right now, let me tell you something. They're not making that much. Okay? Like if I want to just look right now at iHeartMedia stock today, and so what they did, well, let's go and find out. At the quote right now, $2.39. You like that? They're on the NASDAQ. But yeah, look at that. Let me just say for the last, let's just talk about like the old time that all this came back, right? Because iHeart first came back listed on the stock, on the NASDAQ at 1750, drops during 2020, comes back up to what, as the recovery of everybody else goes back up, 2673. Drops. April 22, down from what? 1925 down to $7.20. Right now, $2.33. $2.37. This is acceptable. They're not making any money on for the shareholders. All those people are holding the bag. And all these companies continue to go ahead and just, it's allowed and it's acceptable. And they were allowed, even under a private equity firm, they were allowed to go and go back out and go public again. Only to continue to fail. I don't know why it keeps happening. I don't know why it's allowed, but it is. And, you know, I wish I had a better answer. Not to mention as well, going back to the New York Times, where private equity groups back in 2006, New York Times actually reported about the fact of how Univision Communications, largest Spanish language broadcaster in the United States, a consortium agreed to pay $12 billion. Reader's Digest also went private equity as well, $1.6 billion. Reader's Digest, is it even around anymore? I don't even know if they even sell it anymore. Right? Univision's been changed around a couple different ways, and they're not doing much better. The Tribune Company, which owns papers like the Chicago Tribune and LA Times, remember they've gone through their own private investors, and now they're owned by individual companies and all, and they're not doing much better either, right? And so private equity firms, according to the New York Times, they said they can unlock value by selling off pieces or making drastic operational changes. David Bank, media analyst with RBC Capital Markets, he says, quote, "You can take chances that might cause disruptions, but you can't do it with the quarter-to-quarter pressure of being public." So that's why they go private. And at the same time that Clear Channel was being bought by Thomas H. Lee Partners, they were also part of a consortium that owns Univision. Bain, Thomas H. Lee, and Blackstone also invested in Cumulus Media Partners, buying that business from Susquehanna Falsgraph in May of 2006 for $1.2 billion. And by the way, they're also another company failing as well. Let's talk about them. They're also in the same mix right now as everyone else, because it's another one that's also fallen by the wayside. Because Cumulus was trying to be bought out by another shareholder group, a poison pill. So let's go about that story. So there was a Singapore-based shareholder group that was trying to go ahead and thwart a potential hostile takeover. A limited duration shareholder rights plan, known as a poison pill. They were trying to buy up shares of a company beyond a defined limit, financially unpalatable to discourage acquirers from gaining a controlling interest. And it was what was called significant accumulation of its stock by Renew Group Private Limited, a private equity firm. A July 18, 2023 filing showed that Renew Group Private Limited, they bought a 5.15% stake in the company. Then, reportedly, ownership went up to 10% of Cumulus stock, and Renew decided to go and buy 20% of the company. Now, without going into the details of what the stock needs to go and be, but let's just tell you about this. Cumulus is owned by Renew Group, which also has investments in other media companies, founded by 5-hour energy drink millionaire Manoj Bhargava. He earlier acquired $60 million of Audacy's first lien Term B debt. Also, they signed a letter of intent to combine broadcast networks and Arena Group Holdings, more than 265 brands, including Sports Illustrated, The Street, Parade Media, and Men's Journal. And the company will now own a 2/3 majority stake in the combined company. The prospect of Cumulus face a takeover from an investor based in Singapore is a result of an earlier bankruptcy reorganization. As part of the process, asked for and received from the FCC in 2020 permission to become as much as 100% foreign owned. You see, it's not even allowed we're not even talking about now just in America. That private equity groups in other countries can also buy into this. The only condition the FCC put on Cumulus is that it would need to obtain specific approval for any foreign individual, entity, or group that seeks to hold more than 5% of the equity or voting interest in the company. In some cases, however, that limit will be raised to 10%. And Cumulus will also need to alert the FCC if it becomes aware that it's fallen out of compliance with that requirement. All accepted. All allowable. Really? Really? I'll put it like this. I understand that some of you, if you've been listening to this program, you're definitely vested interest into this program because you're radio people like myself and you care about this. And it does infuriate you to go and hear these kind of stories and what that's been going on with these radio companies. And maybe some of you radio company types that you want to hear what some lowly pissant, podcasts are saying about it from the outside looking in. With no vested interest, because I'm not trying to get myself a job in the radio business. It's like this today, okay? I don't need this. I want to go back. Like when we get local broadcasters or local companies to come back in and do the right thing by companies, I want to come back. I mean, I would never want to shut the door on radio if I had the chance, but what can I expect right now? What can I expect? It's like the dream, the enjoyment, the passion. Like it breaks my heart to go and see this go on to this medium that I love. Like really, this is like me almost like giving a love letter to radio for what it's done for me, what motivated me to be into podcasting in the first place. Which coming up August 1st will be officially 20 years in podcasting. Okay. Sure, Kick a Podcast. Maybe there's others that are doing a lot more than I am, but you know what? Hard for you to go and compare how much content I've done, the passion I have for this business, and how I give a damn about podcasting like I do, because I do a lot. But it's because of what I've been doing in this business for almost 20 years, which is what I've been doing now of media for 30 years. My love for radio. It's channeled and it has influenced all the work that I do. Okay. If I had a radio station to go and broadcast this on, I would, but I don't. These vultures here that are able to go and just take aim and do whatever they want. And these companies can just be manipulated and moved around to wherever they want to go and do. It doesn't matter. They don't really care. It's a damn shame. So there's a couple other stories I want to bring up that are outside of this. And I just figured I'd just go and bring it up right now real quick. Now, this is a bit political, but I'm going to just make the point. So there were layoffs at CBS News. And there was one particular name that was out there that caught my attention. Catherine Herridge. She worked at Fox News before and then moved to CBS as an investigative reporter. An acclaimed investigative reporter, according to The Hill. But there were layoffs by CBS News, and Catherine Herridge was one of them. But here's what was really, this was disturbing. For whatever reason, CBS officials took the unusual step of seizing her files, computers, and records, including information on privileged sources. My guess is she probably has copies of all this. So like whatever they took on her, decided to go and do what they did. I hope she has copies of everything. And we get an answer as to why. And so The Hill tried to speak confidentially with current and former CBS employees. They could not recall the company ever taking a step like this. Employees are confused why Catherine Herridge was laid off as one of the correspondents who broke news regularly and did a lot of original reporting. Right. What we actually want news to do. Investigative reporting. But then there's concerns about the source of the pressure. And a seizure of records from a departing journalist. And the move sent a chilling signal in the ranks of CBS. A former CBS manager spoke on condition of anonymity, said he had never heard of anything like this. And at past departures, journalists took all their files and office contents. The company would box up everything from cups to Post-its for its departing reporters. And the holding of material was outrageous and clearly endangered confidential sources. Now, Herridge has not made any public comments so far about this departure. But I hope it happens someday. I hope we get to understand why this happened. At least give us an explanation. Like, what is that? You're doing this to an investigative journalist. And then what did you, and the findings of this journalist found out. And all she did was what looked like good work regularly. You want to go see her Nora O'Donnell on CBS Evening News or CBS News This Morning, whatever, and you see stories coming from her, and you might not like the stories, but you know what? I think she's doing it with an objective point because she's a reporter, okay, without a particular political slant, objective. But that's why journalism is the way it is today. That's why when you go and read anything that's from a news source, any place, you have to decode it. You have to be able to again find out the information from it, whatever the who, what, when, where, and why. And hopefully you go to enough stories that are reporting on it that they're consistent with those 5 questions. And then if you read the opinion editorial that are embedded and baked into the cake of these stories, you need to realize what's going on there too. Just keep that in mind. But that's disturbing right there. That journalists can actually get their files taken away from them. I didn't think I would expect that in the United States. And listen, I'm talking about, it doesn't matter which side of the political aisle you are. Any journalist being seized of their investigative reporting, seizing their materials, that's scary. That is scary. Okay. The SEC also looks to go ahead and they were actually commenting about First Amendment limits and what could be done about growing misinformation, the threat that's being said. So Anna Gomez, who's part of the SEC, newest member of the SEC, spoke to the Media Institute and said that one of her top media concerns is the growing threat of misinformation. But the role of the First Amendment cannot be overstated, and that's what limits what the SEC can do. She says, quote, frankly, regulatory options are limited as they should be. The Commission is not in the business of regulating content. Our democracy needs a press that is free from interference from regulators like myself. I approach this issue both as the FCC commissioner and a concerned citizen. I've had a lifetime of appreciating the evolution of news media as a consumer. And then she goes on to say that, quote, I know I'm not breaking news when I say there's a lack of trust in journalism. That is why localism, competition, and diversity are the Commission's bedrock principles of media ownership. Having a variety of diverse voices in each community is key to the public interest. And while placing our collective trust in the hands of a homogenous view may have started the mistrust of the news and information, changes in the technology have exacerbated it. So all this right here, she's right about this. But I want to take this as the closing argument here of all this tonight. Listen, this is not me talking about Beyonce doing country, or I could have told you I watched Poor Things tonight with Emma Stone, another sick, twisted movie that I saw, but, quite entertaining. And, sure, I could have found other stories that come in like very, culture oriented, would have gotten probably a little bit of clickbait, or sure, I could have done that. But tonight, no. This is a show for me. This is me using my platform as I want to use it because I need the story to go out here tonight. Another company allowed to get out of bankruptcy unscathed. They got delisted on their stock. Shareholders are holding the bag or they are wiped out of the stocks that they bought. Ill-advised, blind as they were. And you could say it's George Soros or anybody else. But it's still a matter of private equity companies could come in like vultures. And pick apart these companies. This is where I wish the SEC would do something about it. Because if Anna Gomez right here says it, okay? Having a variety of diverse voices in each community is key to the public interest. Right? Localism, competition, and diversity. The SEC, if they care about those bedrock principles of media ownership, they need to break up these companies. These private equity firms should not be allowed to again hold on to what's going on here. But she's also right about the fact that consumers can no longer blindly trust the information that we consume. Nope. Very important what's being said. And that's the case that I have for you tonight. For those of you that listen to this program, I hope, if you listen on the YouTube channel, please do comment. I'd love to get some actual opinions out there. Even if you disagree with me, that's fine. But I'd love to hear from you. But this is the essence, the epitome of everything I have of this program that I've always wanted to talk about. This is a very personal, serious subject to me. Because what Anna Gomez says right there, the FCC is right. Localism, competition for diversity, yeah. Those are the bedrocks of what made radio great. Believe it or not, that's what made radio great. And it's not allowed to be that right now. And it's heartbreaking. And I hate to see this go on. All I can do is continue to this format here, which is something I can't do on radio, but I can do it here on this podcast. And there will be shows that I'll still continue to talk like this. So until next week, we'll get back to something much more lighter, much more fun. Remember, the content is king, and the control of your content is in your hands.